Tonight, we are following a developing story that is quietly shaking the foundations of North American trade, supply chains, and economic trust. According to trade analysts and policy observers, former President Donald Trump has pushed an aggressive position in recent discussions and public statements, demanding that Canada sell critical natural resources to the United States at prices below production cost. This demand, if pursued, would mark a major shift in how the U.S. approaches one of its closest allies. Canada is not just another trading partner. It is America's largest and most integrated economic partner. Everyday energy, minerals, metals, agricultural goods, and industrial materials flow across the border. These are not optional imports. They are the backbone of American manufacturing, construction, food supply, and national infrastructure. When pricing becomes political instead of economic, the consequences move fast. Economists warn that asking any country to sell resources below cost is not a negotiation tactic. It is a pressure strategy, and pressure strategies almost always trigger instability. Canadian officials have not confirmed any agreement, and publicly they have made it clear that selling resources below cost is not acceptable. Behind the scenes, however, uncertainty alone is enough to disrupt markets. Manufacturers hesitate, suppliers delay contracts, investors pause expansion plans, and supply chains begin to fracture not because of shortages but because of fear. This is where the real risk begins. Supply chains depend on predictability. When companies do not know what pricing rules will look like next month or next year, they stop making long-term decisions. That hesitation spreads quickly, from factories to warehouses to consumers. Analysts are already warning that a prolonged standoff could affect industries ranging from automobiles and construction to defense manufacturing and energy production. Canada, meanwhile, is not without options. Trade experts note that Canada could redirect exports, limit supply volumes, or strengthen partnerships with other global markets. None of those options are immediate, but the very fact that they exist weakens the leverage behind aggressive demands. What makes the situation more concerning is the absence of a clear exit strategy. Trade pressure is easy to apply. Removing it is far more difficult. Once retaliation begins, political pride often replaces economic logic. Prices rise, inflation follows, and repairing trust becomes harder than negotiating fair terms in the first place. Former U.S. trade officials quietly acknowledge that Canada is different from past trade targets. The U.S. and Canada are deeply intertwined. Disrupting that relationship does not create clean winners. Business leaders across multiple states are now urging caution, warning that short-term political gains could result in long-term economic damage. Tonight, this story remains fluid. No final decisions have been announced. No agreements have been signed, but markets are listening. Industries are watching, and supply chains are already reacting. This is not just about trade numbers, it is about stability. And in a global economy built on trust and timing, stability is everything. We will continue to follow this story closely and bring you clear, verified updates as they emerge. As this situation continues to develop, economists are now focusing on the deeper structural risks that often go unnoticed in political trade debates. When a country is pressured to sell resources below production cost, the damage does not appear overnight. It begins quietly inside balance sheets and long-term planning rooms. Canadian producers would face shrinking margins. Mining and energy companies would scale back investment. Exploration projects would slow. And over time, supply itself would tighten. That tightening would not stay in Canada. Because American industries rely on Canadian supply, reduced investment north of the border eventually means higher costs south of it. What begins as a demand for cheaper resources often ends as higher prices for finished goods. This is the paradox trade analysts are warning about. You cannot force stability through pressure. History shows that supply chains respond best to trust, clarity, and consistency. When those elements disappear, efficiency collapses. There is also a legal dimension to the story. International trade rules, including agreements under the World Trade Organization and existing U.S.-Canada trade frameworks, are built to prevent below-cost coercion. Any formal attempt to enforce such pricing could trigger legal disputes that last years, and during legal battles, uncertainty becomes permanent. Manufacturers do not wait for verdicts. They adapt by relocating supply chains, raising prices, or reducing output. That is how economic damage becomes structural rather than temporary. From a political standpoint, strong trade rhetoric can sound decisive. It signals strength. It promises fast results, but trade systems do not move fast. They move carefully or they break. Several former U.S. economic advisors have pointed out that Canada is not a surplus-dependent exporter with limited options. It is alternatives. And once alternatives are built, leverage disappears permanently. This is where the idea of a no-exit strategy becomes most relevant. If negotiations escalate and retaliation follows, walking back demands becomes politically costly. Leaders risk appearing weak. So pressure continues even when outcomes worsen. That cycle is how trade conflicts drag on long after their original goals have failed. Meanwhile, consumers often feel the effects last. Higher housing costs, higher vehicle prices, more expensive energy, slower job growth, not because resources vanished, but because trust did. At this stage, no final policy has been announced. What exists right now is positioning, signaling, strategic messaging. But in modern economies, signals matter almost as much as actions. Markets price in risk before it arrives. Companies prepare for disruption before it happens. That preparation alone reshapes economic behavior. As one analyst put it today, the trade wars don't begin with tariffs. They begin with uncertainty, and uncertainty is now clearly present. We will continue tracking verified developments, official statements, and economic indicators as the story evolves. For now, the message from experts is consistent. Strong alliances require careful handling. Supply chains require predictability. And economic pressure without a clear endgame rarely produces lasting wins. That's all for this update. Thank you for staying with us.